In this AMT Insight, I'll be discussing the evolution of physical tightness across base metal markets and what this might mean for prices looking forwards. Now, from this chart on my left, you can see notable tightness across nearby spreads for all 6 of the LME-based metals. And in mid-November, that's been the first time since 2007 that you've seen the cash to 3-month spread for those metals in backwardation. Now, if we look into the reasons for that tightness in spreads, you can see the clearest really is the situation with LME registered warehouse inventories. So these are either near critical lows or have seen a trend and pattern of consistent decline over the course of this year. On top of that, you've had shipping disruption that's continuing to frustrate efforts to deliver metal from regions which maybe have a little bit more available to the areas where you're seeing the worst shortages. So that's regions such as Europe and the US. And the high resultant physical premiums in those high consumption regions have really offset the high costs of hedging inventories for inventory holders in this backwardation environment. And that's helped sustain spread borrowing interest and maintain that higher backwardation that we're seeing, those tighter spreads. Now, if we look at forward spreads, we've also seen those tighten very aggressively over the course of 2021. In this example on the left here, we can see that the December 2022 to December 23 spreads for all the metals again are in backwardation. So that means the nearby prices are trading at a large premium to the futures prices. And the reason for that largely has been that as LME prices have rallied higher over the course of this year, to be on decade highs for most metals, producers have been very keen to lock in those current prices for their future output. In contrast, consumers have been, for understandable reasons, less willing to lock in those higher prices. And also because that there is a myriad of uncertainty about end consumer demand and broader supply chain disruption risks for next year that they're also perhaps concerned about in terms of locking in prices and locking in volumes in terms of future production and consumption. Now that's driven those big backwardations and volatility in forward spreads that we've seen. You've also had risk aversion and poor lending liquidity from financial participants in the market, and that has exacerbated that spread tightness, the illiquidity and the volatility. Now, in summary, really, at the moment, we're seeing in the market some macro risks emerging, particularly to the downside, really, notably from the Omicron variant that's emerged in the last couple of weeks, and growing signs that we're past this peak stimulus environment as we see persisting inflationary pressures start to risk more aggressive central bank policy tightening. And indeed, you see governments tightening some of their fiscal policy as well as the pandemic situation has gradually started to ease. However, I think the key takeaway from this video and this analysis is that the tight inventory situation that we're seeing across all metals at the moment should continue to be an important source of price resilience for base metals in the face of those growing and emerging macro risks to growth.